My mic's working this year, so it's starting off better than last year. But good morning, and once again, just on behalf of the broader Expansive team, welcome to our second annual Climate Summit. We had a great time last year. I thought it was an excellent session, excellent summit, and so decided to do it again. And of course, any excuse to come back to the Whitby Hotel is a good one for my book. Excellent space here. And for those of you who don't know me, my name is Jeff Berman, and I'm a senior director on our registry solutions team, where we work with a range of nonprofit, public, and for-profit entities to implement the registry technology that really just remains core to any environmental market. Now, this panel here today is an excellent way to start not only this summit, but really Climate Week more broadly, because really so much of what you're going to hear over the next several days in the various panels and meetings and events really comes down to capital deployment. Addressing climate change is going to require investment in new infrastructure, in new activities, and new processes. But there's a risk associated with that investment, just like with any other investment, be it the market and the technical risks that are associated with new types of resources, the policy risk that's associated with the incentives that were really put in place to drive those new technologies, and in many cases also the jurisdictional risk that you might have when trying to work in a new region. But really, with that in mind, we've put together an amazing panel of experts and practitioners that are here to discuss how to best approach that risk in order to most efficiently deploy the capital needed for the energy transition. And I'm joined up here by Vikram Wedge, down there at the end, the senior advisor at the Climate Policy Initiative, where he supports strategy and programmatic development and guides the financial aspects of a lot of CPI's analytical work. Now, prior to this, Vikram most recently served as the global head of climate finance and policy at the International Finance Corporation, and has also served in leadership roles across the broader World Bank Group, directing work on areas such as innovative finance, green bond standards, carbon pricing, as well as climate risk and adaptation. Sitting next to him is Riham El-Ghizi, the CEO of the voluntary carbon market of Saudi Arabia. In this role, she led the launch of the first, or of the Middle East's first voluntary carbon market and carbon credit exchange, and has since overseen 3 of the largest voluntary carbon auctions globally, which is mobilizing capital for high-integrity climate projects across not just Saudi, but the broader developing world. Prior to this role, she led investment valuations and structuring at Saudi Aramco, and she also spent 16 years at BP in a number of senior roles, both in North America as well as in North Africa. And sitting next to me is Omar Farouk, Managing Director within Bank of America's Global Sustainable and Infrastructure Finance Group, where he spearheads strategic initiatives in sustainable, digital, as well as core infrastructure. He oversees financing solutions across multiple infrastructure asset classes, including wind, solar, fuel cells, EVs, water desalination, and data centers. And prior to leading the Sustainable Asset Finance team, he was the co-head of Cross-Asset Solutions and Strategies team, and before that ran the Energy Capital Solutions team. Now, before we kind of get into the discussion, what I really admire about this panel is not only the cumulative amount of experience, which probably goes without saying, but really also kind of the sheer breadth of experience. To me at least, it sort of feels like we're in the broader kind of climate and energy transition space. There's a trend towards kind of specialization. There's the carbon markets guy, there's the tax equity guy, there's the renewables guy, there's still a lot of fossil guys out there, but really what we have up here is a little bit of everything, or maybe a lot bit of everything, depending on how friendly you want to be. But there's in my view, there's still quite a lot to be learned from sort of comparing different situations, comparing different asset classes, as we try to tackle these broader problems. So Vikram, to sort of start things off, can you kind of just describe some of the work that the Climate Policy Initiative is doing these days?
Great. Thank you for that, and thank you for that generous introduction. The Climate Policy Initiative is a nonprofit organization. It's a analysis and advisory nonprofit that focuses on effectively, or hopefully effectively, helping governments, corporates, and financial institutions sort of navigate the path to economic growth while trying to address climate change. Of the various things that we do includes a couple of different incubator accelerators that are focused on trying to get innovative financial instruments, not clean tech and not creating new sort of, if you will, financial instruments, but innovative ways of delivering finance, whether it's debt, equity, products like insurance and guarantees, into emerging markets where the need for scale and delivery exists at this point, I would argue, the most. In addition, we sort of work across the spectrum of trying to help with how MDBs should operate, how public development banks, how to build domestic capital markets, especially leveraging domestic capacity through national development banks. And most importantly, I think our flagship product is the global landscape of climate finance with its multiple sectoral and regional attributes, but it's probably the thing that CPI was most known for, at least initially, and that is tracking where the money is coming from, where it's going, and how it's intermediated. So
now, you mentioned MDBs, and you obviously spent the bulk of your career at one. Where are sort of the areas, either kind of the arrangements or the locations, where they can kind of provide the most value when it comes to investing in new infrastructure?
So I think speaking from past experience at IFC, which is the private sector affiliate of the World Bank, and the innumerable attempts to try and align the organization with the public sector arm, I would start by saying that I think creating the environment, the policy environment, and the regulatory infrastructure is going to be critical. One of the things at IFC, where we were focused primarily on providing capital to emerging market projects, whether they be in infrastructure or in any of the education, agriculture, health, energy, was sometimes a lack of sufficient policy framing around the whole idea of mobilizing capital from abroad, particularly. So I would argue that, I would suggest that that is critical, and a lot of the MDBs are focused around that. The other thing I think where they could play a role is obviously, and it's been a focus of a lot of discussion at G20 and otherwise, is around mobilizing private capital. And I think their model, while focused on bringing in some level of syndicated private capital, is starting to shift finally into actually what we could argue is the originate to distribute model, which wasn't what it was all these years, right? We do a deal, the MDBs do a deal, the syndication desk calls up Bank of America, Citibank or something and say, you want to come along with us, that's fine. Large infrastructure deals happen, but it's not as though, but most of the bulk of the assets are kept on the book, as opposed to de-risking business development and de-risking. They have a huge footprint in these countries. The money is in the global north. The activity and demand is in the global south, and they can act as a huge bridge if they originate, they de-risk, aggregate, and then sort of distribute that. It's starting to happen. We are seeing the IDB, which is focused on Latin America. IFC did a deal recently, Asian Development Bank. They're all trying to, African Development Bank, they're all trying to do that. And the final thing I would say is part of the de-risking is, in fact, leveraging both blended concessional finance to help mitigate some of the risks, but also moving a lot more into leveraging their own balance sheets through guarantees and other such products. So stop there. There's more I can talk about, but.
Well, I'd actually kind of like to move in a little bit. Like, when you're kind of like talking about risk in this, what what types of risk do you think like an MDB is probably most well suited? Would it be something kind of like a loan guarantee, or would it be maybe trying to even encourage kind of policy changes that are necessary for the private sector to sort of move in?
So I think it's a bit of both. It depends on what MDB you are. I tend to speak, or my experience is anchored in a multilateral that focused on investing in private sector and mobilizing private capital. But I, while doing that, realized that things like what are called development policy loans, which, for example, the World Bank does and some of the other MDBs do, are critical to engage sovereign governments in establishing the kind of frameworks that are necessary for, say, a capital markets to sort of thrive, or infrastructure, especially, and linking back to capital markets, how the whole issue around securitizing and even guarantees sometimes are a challenge with several central banks just trying to provide guarantee and offshore guarantee, for example. So there's that. There is the whole, I would say, the de-risking comes from providing, of course, originating, but also providing finance, but at the same time helping originate, but also do advisory services, like the PPP model, the public-private partnership model, sort of came from that approach, right? In order to get a deal done, you need to do a lot of work ahead. And so that sort of bridges the public side to the private side, and a lot of infrastructure gets done, whether it was the old BOT or boot models or whatever. They were all public-private partnerships in many ways. So helping create that infrastructure. And then also, I think, I mentioned concessional finance, but there's also this whole results-based finance, right? Which also, then you structure transactions which then get rewarded. It doesn't have to be just carbon market related, but there are various ways where you can do output-based financing, which is essentially providing funding for missions accomplished, or at least milestones of missions accomplished. So there are different ways, I think, different parts of that MDB and larger DFI ecosystem can operate.
Got it. Now, Omar, kind of, it sounds like Vikram's trying to set you up for success here. But kind of like thinking kind of like from the perspective of kind of like, the private sector, private investors, when you're thinking about a kind of an energy transition project, and obviously it's a very large category of work or regions or activities, what sort of variables determine how financeable a project might be?
Sure. And Jeff, thanks for having me, and I'm glad I'm here. I can share my thoughts. Look, when we're looking at a project, it is a little bit all of the above, right? So let's imagine that it's not, a solar project today, right? We're talking about doing a solar project 15 years ago, or maybe it's a hydrogen project today. I think, and Vikram said some of this, right? Like regulatory support, what I call regulatory tailwinds are super critical, because these are large infrastructure projects. And as financiers, we are very focused on and making sure that what we're financing isn't the first and only project. So we want to make sure that there is regulatory support to continue down that road and do multiple projects, right? Because that's where you really get the scale, and that's how we all benefit. So in that case, we're looking at the technology. We're looking at the viability of the technology without subsidies in the future. And how does it compete with other technologies? We're looking at the market demand. So in a lot of markets, you may have government support, but what we really want to know is there a time period? Are corporates, are private institutions, are municipalities looking for this product on a pure economic basis? Because that's where it goes from, that's where the hockey stick really starts. That's the market segment. Then we're saying, what is the technology? Does it work? What are the competing technologies? What's the cost curve look like? I would say that is like the highest gate for new technologies for energy transition. Once we're past that, then you're to your basic, project finance principles that we look at every deal. What's the currency? Where is it located? What's, how good are the, enforcement laws? Who's the client? How do the economics stack up? And I would say, and this is coming back to the MDB, conversation, where as we look at these, where we think the private sector needs help isn't in all of the above, which is like a very critical component. Oftentimes it's really like, hey, we want a loan guarantee on everything, or we're not participating, right? We have seen projects where we're saying, look, we understand the technology, but we need help on the currency risk. Or we can take the currency risk, but we need maybe political risk insurance. Or we need downside protection from a technology perspective. So those, if the tools can be more granular when facing between public and private partnerships, it's actually really helpful, because the most important thing for private investors is to put the asset on the book and then see the data and see how it performs, because there's no better validation of your risk thesis than actually seeing it perform as expected.
That's very interesting. So kind of like thinking about the utilizing the MDB not just as this all of the above, but kind of specific tools within their tool belt that they can address.
That's
whether
right.
it's kind of a MEGA loan or some sort of currency support or policy support. And just very quickly before we turn over to Riyam, I mean, you're sort of mentioning, are the policies there in place? And kind of thinking to the U.S. right now, where even some federal incentives that have been incredibly popular and incredibly successful are really kind of at risk of either being turned off completely or a phase out or a sunsetting that's far closer than what we might have expected. How do you sort of mitigate a policy risk when, in many cases, the policy is what's driving the activity, if not entirely, certainly to a substantial portion?
Yeah, I mean, I'll just answer that, kind of like the way it comes down to basics of how we think about it, right? The renewables, I mentioned earlier that it was 90% of grid new additions was solar last year. In many areas of the U.S. and in many areas of the world, solar plus storage is the most competitive resource addition. I think the interesting thing is that today, just not in the U.S., but in the world, it's for the very first time, it's not very first time, but maybe in the last 25 years, we're in energy growth mode. We just need more power, and we need it in a lot more places. So I think the regulatory incentives are important, but if I go back and I look at it, transactions we did 10 years ago, the power purchase agreement used to be, for a wind deal in Oklahoma would be $18. And now it's $55, right? So the private market and the off-takers and energy demand is sending the right market signals, where people should be, in many areas, should be able to build just based on the economics alone. At the same time, the guidance is trickling in. There's many developers that have safe harbored equipment, and they'll have a pathway to get that transition from an industry that requires a lot of incentives to an industry that can stand on its own.
Yeah. I want to come back to that because there's a number of people in the room kind of like working on new technologies that might find this interesting. But Riyam, I'm kind of like turning it over to you. So the voluntary carbon market of Saudi Arabia, this is still a relatively new initiative. But can you kind of tell us a little bit about what's sort of driving the initiative when it comes to sort of capital deployment?
Okay, just want to say thank you for Expansive for having me here today. And I want to mention that the partnership with us has been very valuable, specifically providing our infrastructure and the level of cooperation. We're working together in new instrument in Islamic finance, which is really a very good one. I want to talk about Saudi Arabia and the region, and the question that I always face, why Saudi Arabia is doing this. Everybody would see the Saudi Arabia as a petrostate, right? Why are they interested in climate change? I want to take the audience to Saudi Arabia, Middle East, and North Africa as a region. Our region is the fastest, 2 times, the impact in climate change is 2 times Middle East and North Africa and the Arctic. So in some areas in our region, in Saudi Arabia, the 2 degrees Celsius scenario is there. So we're warming up as fast as the world, but 2 times faster. By the end of the decade, it's expected that in our region, the Middle East and North Africa, the climate increase would be 9 degrees Celsius. We're talking about 2100. So we're talking about economic impact, a loss in GDP by 12.5%. And these are by, all of these are Atlantic Council, Northeastern universities, KAUST. So the impact on our region is huge. We are the fastest, like the Arctic. We've seen in Pakistan, 1/3 of the country was under flood. If I talk about Egypt, we're talking about food security, the salinity of water for agriculture for 120 million people. And we're talking about Saudi Arabia, where heat waves are prolonged, above 50 degrees Celsius. What does that mean? Someone might say, we could have ACs. I disagree, because it needs power plant, and power plant uses seawater for cooling, and when the water is hot, you cannot cool. So we've seen here in Connecticut, power plants shutting down because of the hot water in the sea. So all of these are challenges that our region is facing, is impacting population displacement. It impacts the coast. And we're talking about population displacement that is expected to be around 500 million from our regions to elsewhere by 2050, 2100. This is why we see a lot of boats in the Mediterranean. So we will see more of that. So this is an existential problem for our region that nobody looks at it from that perspective. And this is an important thing to look at, the water scarcity, the underground water levels, and all of these things. This is why this is a very important topic for Saudi Arabia, for the Middle East, for North Africa. What are we going to do with that? Comes with that financing. Not every country is endowed like Saudi Arabia with some funds that they could spare for that. Some other countries wouldn't have, like what Vikram has mentioned, you have mentioned as well. And this is where the voluntary carbon market could play a role as a market instrument. So why is this important for the kingdom? The kingdom is testing the demand. Before I started this whole project in the kingdom, and it's funded by the Sovereign Wealth Fund of Saudi Arabia, PIF, there was zero supply, zero demand, no conversation whatsoever about carbon market. It's a way of channeling funds from global south to global south. We're talking about global north. And guess what? Funds are not channeling fast enough. There's a lot of questions about governance, frameworks that we talked about. I've been in Kenya, I'm cooking on cook stoves with women. Funds doesn't funnel and go fast enough. Carbon markets, if fixed, could be a very effective tool. It impacts farmers, it impacts women, it impacts small individuals, and it tackles that level that we cannot tackle with high guarantees or whatever from big governments. So this is why I see voluntary carbon market could be another tool, and we need a lot of tools to tackle the climate action that could accelerate funding small projects, funding big projects like carbon capture and storage. It's a very important market. What we have done is we looked into signaling demand. Is there demand in the kingdom? Yes, there is. That demand would, as you mentioned, back to back, one of the biggest auctions that has ever happened. We had the likes of Saudi Aramco, we had the likes of SABIC, banks and whatnot, participating in that. And by that, they are channeling funds to Africa. The second auction we had in Kenya, because we wanted to draw attention to the underinvestment in Africa when it comes to projects. 75% was what was auctioned was from Africa. Projects from South Africa to Morocco, to Egypt, to Uganda, all of these countries that carbon market could help accelerate climate action at a level of farmers, a level of women, a level of solar energy, wind energy. So this is why I find voluntary carbon markets very important. And for Saudi Arabia, I explained why climate change is a big deal for the Kingdom of Saudi Arabia and for our region as well.
So just to sort of build on that a little bit, are there specific types of projects or specific regions that you're focusing on, or is it a little bit more agnostic?
So last year when we launched our exchange, we had some projects from the United States for negative cement that absorbs CO2 from the atmosphere. This is a new technology, and it's a very important one. We have biochar from Brazil. our focus is mainly on the carbon market. The majority of the projects come from the Global South. So by nature, when we engage in the market, the credits and the carbon credit certificate come from the Global South. Nonetheless, we fund new technologies like, as I said, negative cement was a very exotic one. We thought as a new one, we could introduce it to the Saudi market. There's a lot of construction that is happening with mega projects over there. So negative cement could be another thing that we could import or bring the technology in. So there's a lot of cool stuff. I want to mention one project that I think carbon market could play a big role. I'm African, Egyptian. So one of the conversations that we were having a couple of weeks ago is because Egypt is taking a lot of loans from the IMF, subsidies has been lifted, specifically from fossil fuel and diesel. Farmers, around 50 to 60,000 farmer community cannot afford getting underground water anymore with no subsidies. The government told them to turn into solar. They cannot afford having the infrastructure for the solar. Here, where we're talking about carbon market, when we can replace the energy for solar by carbon credit offset to help farmers get their underground water. This is water security, this is community security, and so on and so forth, that the market could play a role in helping different communities. These are projects we're interested in, for sure.
That's very interesting. And to sort of kind of, I think we have about 10, 15 minutes left. We see, on this panel, you kind of have a private investor, a bit of a sovereign investor, and then our stand-in for kind of the public sector right here. And thinking about this, what are sort of the types of risk that these three types of investors are kind of like best suited to handle? What should the development banks be doing? What should the private sector be doing? What should a sovereign wealth fund and sort of maybe a degree of flexibility that sort of implies? What areas are each of these types of investors kind of best suited to work in? Starting here.
Sure. Look, I think what our role in this solution is providing scale. Right. So the way I think about it is that the MDBs, sovereign wealth funds, they're helping set the policy, the frameworks, which I think the MDBs have done a great job in terms of setting up the auctions and making things financeable. But then the private market needs to come in, and then it needs to scale. So we are, I'm at a bank, so my job is to kind of bridge between, MDBs to capital markets, and then the capital markets takes it to the next level. So what are we looking at? We're looking at business models. We typically want mature or maturing technology. That's where we're going to be best suited. We want a protection on currency and jurisdictional risks. Right, so we're just by definition a little bit later in stage because our role again is to provide that scale that's really needed, for these problems.
Brianne?
Okay, one of the things that we really struggle with is political risk. We talked about megas and whatnot. When we invest in different countries, one of the countries that we were really interested in Africa had a coup. We're talking about political risk here in the United States IRA, and then it gets reversed. All of these doesn't provide, even though we are a sovereign wealth fund, we are a commercial company, and we need to return profits to shareholders at the end of the day. They are investing for the future generations. So political risk is a big thing for us. Regulatory risk is something that we discuss on our board all the time. And guarantees, one of the things in the carbon market that needs to be tackled intensively is the insurance, because the quality of some of the credits couldn't be insured. What if the project doesn't continue? Do we have replacement credits with the same quality, same co-benefits, and so on and so forth? Carbon credits are not fungible yet. And as such, there is a lack of standardization. There's a lot of work to be done from a regulatory perspective, from standardization perspective. Last year, with the past administration, we've seen a lot of papers coming for recommendations, which is really good. But it would be really good to have something standardized like the IFRS funded by governments and whatnot for the carbon market, because it's very initial, as I said, it's very important to accelerate climate action. But I would say political regulatory risk in investing in different countries is a big deal for us.
Vikram?
Yeah, never new role, public sector stand-in, but that's okay. Look, I think the role that some of the MDBs played rightly was do the first of their kind projects, the solar projects, the wind projects. If you go back to their portfolios, a lot of them failed. But the whole idea was to help start creating a market and force the sort of both the interpretation, evaluation, and addressing of risks in a way that allows ultimately for what the folks Omar was saying about Bank of America and other places, right? To ultimately come in and scale. So there's political risk, there's sovereign risk, there's credit risk, there's technology risk, there is off-taker risk, there is forex risk. There's a whole bunch of risks that have to be addressed before all that money from the global north unlocks it. So people say there's no shortage of money, there's shortage of projects. I would argue that there is shortage of projects, there's no doubt, high quality projects, where I think a lot of work, good work's being done. But this no shortage of money is a myth, I think. There is a lot of money, it's just not flowing into Global South for all these risks. Now, can the MDBs and the DFIs address all these risks? No. But climate is upon us, right? And the impacts of climate. Forex is it's not a new risk. It's a risk that development finance has faced for 30, 40 years, since whenever the Bretton Woods institutions have been in place. They haven't addressed it in 40 years. The problem is that it was nice to have, right? I'll be honest. I mean, it's a little controversial, but addressing poverty, nice to have. It's like the charitable contributions we make ahead of our tax deductions. And okay, maybe a bit of an extreme, but climate change is here to bite us. Everybody. So it's a problem. Money needs to flow, forex, and all those other risks need to be addressed. So there's a lot of effort and work that's actually starting to go in, which the climate finance flows are shouldering purely because they haven't been addressed in all this time. I would argue that there is still a lot of expectation from the Global South that's not likely to be met. I mean, there was an argument somebody was making, why doesn't the Zambian, picking a country in Africa, why doesn't the Zambian pension fund invest in Zambian infrastructure? Why are they investing in UK real estate? And my counter to that is, for the same reason the UK pension funds are investing in UK real estate and not in Zambian infrastructure, because at the end of the day, every pension fund is looking at its fiduciary responsibility to its pensioners. And the risk for the Zambian pension fund is no different. We should be looking at development dividends. We should be looking, somebody mentioned sovereign wealth funds. I think sovereign wealth funds have an interesting role to play either in country or regionally. I think they can be brought in to create certain de-risking tranches. I'll stop with one example. One of the things that's at CPI, one of the early things that were incubated in the Global Innovation Lab for Climate Finance was something called Climate Investor One. It's a Netherlands-based, Hague-based fund manager that focuses on emerging markets. They're on like their third version. We did Climate Investor One, which focused on renewables. There's 2 for water and oceans. There's 3 coming along. But the whole idea there was a grant tranche to help do business development, an equity tranche, and we haven't talked about equity. I think equity is hugely, and especially catalytic equity, can go a long way in doing a lot of the de-risking, which funds these projects that have been given the development grant. And then there's a refinancing, debt refinancing component. So what it's doing is actually addressing some of the issues that even the projects in emerging markets face. De-risking, yes, but not having to go door to pillar to door, trying to figure out how am I going to refinance, where I'm going to get my equity once it's de-risked, where am I going to get that. Only trouble is it's $1 billion worth. We need about 150 of these at least operating in order to, if not 1,500, some people would argue, operating in order to get moving. So there are ways of getting done. I just don't think we are doing it at the speed at which we need in order to get this gap addressed.
Okay.
And then I have a comment on voluntary carbon markets that I'll save for later.
I think he'll have a chance. We have about 5. I'm taking an extra 5 minutes because we started late because of John. If I planted a question, start raising your hands, or even if I didn't plant a question, raise your hands. But to sort of I want to follow up on something that Vikram said, because I think that this is very interesting. If we had to have a spectrum of risk here, kind of like investment risk, you have UK real estate and you have Zambian infrastructure. And it seems totally logical that investors, regardless of who they are, would sort of lean towards the UK real estate for a variety of reasons. I mean, maybe this is a little kind of simplistic, but how can you get people to take on more risk? How can you make investors a little bit more willing to kind of say, yes, actually, there might be some benefit, short-term, medium, long-term, towards the riskier regions, towards the riskier kind of first or second of a kind technologies, and sort of beginning to mobilize capital there. I mean, it's where my head always goes is frankly to solar, because it's all well and good to say, oh, solar, it's the cheapest asset, or the cheapest form of generation, lowest cost resource, all of that. The reason it's like that, though, is because the German taxpayers were forced to pay 300 euros a megawatt hour for 10 years. And how do you kind of get to that situation where we all look back in 2035 and say, of course it's the lowest cost resource. So kind of kicking it over to there, it's a bit of an open-ended question, but more risk is what I'm sort of looking for.
Do you want to go
first? You go first.
Yeah. I mean, look, I think if you just zoom out, right, every people's portfolios, personal portfolios, and even, as you get the institutional level, there is a pocket of capital for emerging markets, right, typically, and it's divided up into different currencies and different buckets. There are emerging market, strategies that are out there. You can invest in them. I think it comes down to, so I don't think it's risk per se. I think maybe that pocket of risk capital needs to be bigger, but the capital exists. It's also about return and return expectations, right? So if you're investing in emerging market infrastructure with Forex risk, your expectations are higher than UK real estate, right? And if everything is priced equally, they should be. Now, sometimes that's the case, sometimes that's not the case, right? And I think part of the question we're trying to answer is when that's not the case, because this isn't necessarily, there is a greater benefit to that project that isn't quite reflected in the numbers. How do you increase the return for investors that are truly thinking about it from a private capital perspective? And maybe that's where voluntary capital markets can step in and bridge that gap.
I just want to make a small comment about the solar and the fact that it's the cheapest. I don't agree fully with that, and I would say why. Some grids are very different than the others. Without storage, like what you mentioned, is very challenging. For instance, we did a study in Saudi Arabia that above certain level, the intermittency plays a big role. And I compared that with Germany, with India, with China, and that's why switching from coal to solar is not being accelerated, because it is different from one grid to the other. It is very important to note that and think about it and how to accelerate shutting down coal plants, because some directions you need to switch to solar. It's not that easy. It's not that cheap as well to shut down your plants and switch from solar. It depends on each and every grid and how it is designed and what you depend on. So this is a very important thing for me. The other thing that we worked on is how to accelerate the shutting down of coal plants and replace it with solar, and how carbon markets could play a role in financing that as well, because there's a lifetime for power plants. We worked with gold standards. We worked with with the Vera, and we ended up by the John Kerry initiative. This is something that we initiated in the kingdom. And this needs to be looked at jurisdiction by jurisdiction basis. So this is a very important thing. Carbon market could play a big role in that, in financing that, specifically with some of the greenfield ones. As I said, infrastructure is not easy. I talked about the farmers earlier. Not that easy to switch. So carbon market could play a big role in tapping into that and funneling some of the funds from corporations, because at the end of the day, the buyers are corporates.
No, absolutely, and you're right. Kind of think about it from the U.S. mindset, where the coal fleet is 80 or 100 years old, as opposed to in East Asia, where it's a new, efficient fleet. That's actually a great segue, probably, to our next panel, the one after by Brian Fellon, about kind of addressing intermittency in the power sector. Vikram, just very quickly about carbon markets.
Yeah, I can come back. Yeah. Just to enhance her point on solar, I think solar's competitiveness, yes, for full replacement, you're going to need battery storage. But look at a lot of Africa, where the need is off-grid and a mini-grid, the decentralized solutions. Solar is not yet competitive fully there. So there is a need for, whether you call it subsidy or a German-type approach. To address your quick question on risks, I think risks are in the eye of the beholder and the term over which you do it, right? I mean, if we had a long-term enough vision, from an economic perspective, you would incorporate the impact of climate on all your portfolio, long-lived portfolio. You would consider the impact of mass migration. You would consider all of that, which should lead you to look at those benefits and increase or decrease, the hurdle rate, the returns that Omar is talking about would be different. But the problem is, we don't have long-term enough horizon in our calculations, even in the economic context, but leave alone at the financial investment framing, right? So if you started to incorporate all those risks, you would argue that some of the investment needs for the emerging markets should be addressed more critically and urgently, because that's where some of the prevention and reduction of this risk could happen. But that is a bit of a too long a time frame for people to worry about, right? And you can argue that Forex should be taken care of by sovereigns, but most of this, and the development dividend I referred to, if I have some good infrastructure to go in, I should encourage my pension fund to do it and give them a subsidy implicitly. Most of these governments are already debt burdened. So, there is fiscal headroom issues in these countries. It all sort of comes back to trying to solve multiple issues simultaneously, from debt burden to risk to flows, in a way that optimizes this. We're all working on it. Carbon markets were hopefully going to be, just to end with that, going to be one answer to redirect flows to most efficient low carbon, zero carbon solutions, cheapest available. On the other hand, they haven't. I mean, I spent 10 years of my life in carbon markets, version 1, if you will. My only comment on voluntary carbon markets is that it's still reliant, carbon markets, because they're voluntary, are reliant on what I would call corporate charity. To her point, yes, corporates are the buyers, but it's all out of their CSR budgets, right? Unless it's going to get onto somebody's balance sheet, and without some sort of a compliance overlay, that's not happening. I don't see how we get to the volumes of carbon markets that the infrastructure is capable of delivering. So I'll stop there.
That's the perfect segue to the audience. Any questions? Right there. Yep. Any thoughts?
I would say, where we see that is typically private capital, but the capital is typically dilutive, right? So we've seen folks come in at that stage, make an asset level investment, and also make a corporate level investment at the same time to kind of just, bucket their return. For technologies where we've seen successes where you can really make the case that this is something that's going to have a lot of adoption in the future, and it can be economical, right, and compete on its own in X number of years.
Can I add something?
Please.
One of the things that I really like about Saudi Aramco, and they have their own venture capital, it's around 7 billion, is they mandate the deployment of this technology within their ecosystem. So they prove a case. It's not a proof of concept, but they make it working on the ground. And this is something I have noticed, and is a very good one. Now, Saudi Aramco has the leverage to do that. For us, when we look into technologies, we want to deploy new technologies. We look at why Saudi Arabia is using a lot of cement. We're constructing, there's the FIFA, there's the World Cup, there is a lot of activities, new cities and whatnot. And for us, some of these projects has pledged to net zero. So deploying that and working on the technologies is very important use case, and it comes at the top of the house in the country. How do we do that elsewhere? Once a proof of concept happen and one company uses it and starts saying we're using it, then maybe that would open the way for others to deploy it as well.
So I think outside of DFI, development finance institutions and sovereign wealth funds and state-owned enterprises, we're looking at one of our incubators, the Catalytic Climate Finance Facility, supporting a project, a fund that is only going to be doing first of its kind, but it's very focused, it's sector focused. It's going to be ocean and related infrastructure, right? So I think Omar mentioned it, the structure is such that it is bringing in debt, but also equity from the corporates that are going to be involved in delivering these first of a kind projects in a way to sort of de-risk the ecosystem. But it's a small ecosystem, it's very focused, it's not large, that depends on either multilateral largesse or big public policy reforms. It's only 400 or 500 million, but to your point, it needs to scale 10x at some point soon.
Thanks. Any other questions? Otherwise, we'll free you guys for coffee. Well, wonderful. Please join me in just thanking all the panels for this excellent discussion. And looking forward to the next session. Thanks.
Thank you.
Yeah, great job.